Intelligent Investor by Benjamin Graham. That's the book we're going to be speaking about today. For the uninitiated, this is a timeless classic with a lot of technical and psychological and basic fundamentals around investing. In fact, Warren Buffett calls it the best book written on investing, right? So for anyone who's just getting started with their financial journey, I wouldn't recommend you starting with this book because it has a lot of technical analysis. It speaks about how you should analyze balance sheet, what are the things you need to look at, and all those kind of things. But underneath all of this, Benjamin has discussed a few investing principles, which is what we are going to be breaking down. So I'm going to be breaking down 7 investment principles that should be guiding how you invest. Investment principle, or the takeaway 1. Invest based on fundamentals, right? So the mistake that a lot of investors tend to do is to invest based on FOMO or very random recommendations or half-baked information. So how often have we seen people going behind a fad or investing because of FOMO and ensuring that they are losing a lot of money? For example, during the pandemic, I remember a few of my friends who invested in crypto because everyone, the mob was going around it and things like that, only quickly to realize that they didn't know how volatile the crypto market is. So never get into something without the full knowledge of what you're getting into, how volatile that is. Investing on fundamentals means you're investing based on strong financials, reliable earnings, and a solid balance sheet, right? So you have ensured that you have taken your time to study about each company that you're investing in, or each instrument that you're investing in, and not investing based on FOMO. Lesson number 2, there is no place for emotions in investing, right? So this is one of my favorite lessons. In fact, Benjamin opens this book by speaking about 2 kinds of investors. Investment 1, which is the kind that I am of, which is the defensive investors, and an active investors. So typically a defensive investor is someone who is okay with a slightly above average returns or an average return and doesn't track the market very actively, but makes patience his or her ally in investing, right? For example, an active investor would be someone who's tracking the market very closely, studies companies in and out, and is actively speaking to executives of those companies, in various people from the investment sector, speaking to people from the banks before taking a wise decision on where or in which companies they should be investing in, right? So Benjamin doesn't recommend anyone becoming an active investor unless you have a lot of time in your hands and you have the brain power and mind space to analyze companies in and out, right? Because what ends up happening when you're investing without studying fully is, 1, you don't know what you're getting into, and 2, you might end up picking things where value of your money might be depreciating faster than you think. So irrespective of whether you're choosing to be an active investor or a defensive investor, Benjamin always recommends that we make time our ally and not do a lot of intra-trading things and stuff like that. The third lesson is invest, don't speculate, or rather don't try to time the market. The nature of stock market, friends, is kind of very volatile, right? One stock might go up one day, it might come down the other day, it might just stay stagnant for extended periods of time and things like that. And if you're not knowledgeable enough, or rather if you're investing based on speculation, you will end up with losses more often than not. So what does a good active investing look like? You're studying the company's fundamentals, which is what we spoke about in the first point, which is you're seeing into the financials, the balance sheet, and how profitable the company is, how valuable it is. You're speaking to people who are related to this company, you're getting the market sentiments and things like that. And the third and the most important thing is you're staying invested in this company for a very long term, right? So what does speculation look like? Speculation looks like you investing based on some short-term trend. You're investing based on the fact that someone has told you that they've made a 20x money based on this stock or this sector and things like that, without doing a lot of careful analysis. Because more often than not, these fad giving high returns might be the exception and not the norm, right? So before you kind of start investing, ensure that you're studying all your companies in and out, and you're meeting people from the relevant industries, and ensuring that you know what you're getting into. Because with markets, there are a lot of things that are not under your control, and you might end up being in the losing side of things if you continue to speculate. That brings us to lesson number 4, which is to avoid the losses, always diversify your portfolio, right? So diversifying portfolio could mean you're parking some amount of money on your real estate, some in your stocks, bonds, deposits, other investments and things like that. But Benjamin Graham always recommends you splitting your money across different areas to ensure that you are having a safe landing in case one of your investment kinds of ends up misfiring, right? So how should that mix look like? How much of the split should be in a risky portfolio versus a safe place versus a medium return thing? It totally depends on whether you're an active investor or a defensive investor, and what is your risk tolerance and how much are you willing to put in the market and things like that. The important thing to remember is there is no size fits all when it comes to investing and diversifying your portfolio. You do you after careful analysis. Lesson number 5. Embrace the power of compounding, right? Again, this is something that's spoken about in a lot of books around investing, and Benjamin Graham doesn't fail us to kind of teach about the power of compounding. In fact, Warren Buffett and a lot of billionaires who have made a great fortune from the stock market have stuck to this principle of compounding. So what does compounding really mean? Let me explain it with a small example, right? So let's say you get $10 for every activity that you let's say in this case, let's speak about producing a YouTube video, right? So you get $10 with an increment of 10% every week for producing a YouTube video. Let's say parallelly your friend gets $5,000 every month, irrespective of whether he or she produces a YouTube video or not, right? So at the end of month 1, you will end up having $51 with a 10% increment each week. At the end of month 1, your friend will end up having $5,000. End of month 2, you will end up having $125 roughly. Your friend will be having $10,000. So at this point of time, your friend is kind of starting to poke fun at you, saying, hey, you know what, you're very stupid to kind of have these compounding increments in your income. You should rather take 5,000 in bulk. So come month 12, your friend is going to have a whooping $60,000, at which point you will end up having a meager $15,500 in your bank account. But let's say you keep increasing this week on week, month on month. At the end of month 24, your friend will end up having $120,000, and guess how much you will end up having? You will have a whopping 2.2 million in your bank account, and that's with a 10% increment month on month. Now imagine this compound effect happening over 20 years, 30 years, 50 years, right? So never disturb compounding is what Benjamin Graham advises us. Find good valuable companies, invest in those companies and sit on them for the rest of your life, and he assures you that you can make a ton of money. And how do you find those valuable companies? He discusses a lot of formula which we are not going to be getting into. Lesson number 6. Learning from your past mistakes. This is a very dear mistake not a dear mistake, dear lesson to me, because what a lot of us fail to do is, especially when it comes to investing, is we make some mistakes with our investments, or we make mistakes with diversifying our portfolio, or we make mistakes with how we study companies or finding valuable companies. We totally kind of disengage or never take into account the mistakes that we make, but we continue to make those same mistakes, right? So what Benjamin in fact tells us is, hey, if you've made a mistake, it's okay. All of us make mistakes. You can't make right decisions all the time, right? So always note down what are the mistakes that you're making to ensure that you're not making those mistakes when it comes to investments or diversification or picking the right kind of stocks, right? So once you have a document of all the mistakes that you're making, you can avoid them. And at the end of the day, it's in investing, it's all about you getting it. The number of your right decisions just need to be one more than the number of bad decisions you make, right? So always ensure that you're learning from your past mistakes and your decisions are coming from a point of awareness and not from a point of short-term fad or a short-term trend that you're seeing. The 7th and the final lesson is seek advice from experts. This is my favorite lesson. So don't listen to if some YouTuber like me says, hey, invest in this stock, invest in that stock and things like that, unless they are a certified advisor who are eligible to advise, right? So if they have the certification, they have the qualifications to provide you investment advice, always take it from them rather than taking it from a random person who would come back and tell you that, hey, I made 20x the money, 30x the money, I 5x my money based on some WhatsApp forwards or some trend that you read on Twitter and things like that. Always ensure that you're seeking advice from experts and your decisions are coming from a point of awareness and careful analysis rather than it coming from a point of view of, hey, let me get rich quick. Because as Warren Buffett said, The problem with most people wanting to get rich is they want to do it very quickly, which shouldn't be the case. So make time your ally, make patience a virtue when it comes to investing. Stay disciplined, and over a period of next 30-40 years, you will make a ton of money that you can't even fathom. So until I see you in the next video, this is Praveen Ramesh signing off.